markets stay up. It was interesting to see the bulls dominate, keeping the indices up despite the selling that kicked in after an early and positive start on Thursday. The markets appear to be primarily driven by factors like lower oil prices and in some sectors like air conditioners and energy riding on projections of higher temperatures and a hotter summer. Low oil prices means the economy benefits broadly because we import almost 80% of our requirements, and also a lot of oil-linked companies benefit, which could include the refining companies and companies who use intermediates like paint companies. The Sensex and Nifty were up for the second consecutive session, and the 30-share Sensex closed up 609 points at 74,340. The NSE Nifty 50 was up 207 points to 22,544. The Nifty 50 is down at this point about 14.2% from its record high hit in late September. The broader markets did well too, with small cap shares staying ahead, with the Nifty Smallcap100 index going up about 1.3%. The Nifty Midcap100 index was up slightly less at about 0.4%. Makers of air conditioners and cool beverages and power companies saw an uptick in their stock prices on March 6th as investors expect stronger sales in the upcoming summer season, according to Money Control. Now, while tariff fears are keeping world markets on an edge, the flip-flop is also evidently tiring traders out. For example, the US has imposed tariffs on Mexico and Canada at 25%, but is carving out or away energy and then cars and then now apparently agriculture. Despite all these trade tensions, Asian currencies have remained relatively resilient in light of a broader dollar decline and worries that US growth is slowing, according to Reuters. Meanwhile, on Wall Street, stock futures were under pressure on Thursday as investors sought out more clarity on the latest US tariff measures, CNBC reported, adding that futures tied to the Dow Jones Industrial Average fell about 378 points. S&P futures and Nasdaq were all down more than 1% each. So how do we view the current uptrend in the market, that's the domestic market, from a fundamental or technical perspective? I reached out to Chokkalingam, veteran market analyst and founder of Economics Research, and I began by asking him what had changed, even if for only 2 sessions.
Definitely, oil plays a crucial role because if you look back 2016, when the global deflationary conditions emerged, again COVID time, oil price crashed unbelievably, and that alone, I could say that gave a very predominant relief to the Indian economy and therefore largely contributed to the market recovery. As of yesterday closing, the oil price is down 27% from 52-week high. We roughly put about $143 billion worth of oil. So just imagine 25% fall can save you around $30 to $33 billion, which is more than our Indian pharmaceutical industry exports. So the kind of impact it will have on foreign exchange reserves, rupee exchange rate, inflation, and also the corporate earning, particularly the segment which uses oil or oil derivatives as input. So it plays a major role. That is one of the reasons this time. And apart from that, the Q3 GDP also gave a little confidence. Of course, number came a little early, but then market was terrified by Mr. Trump's statements on or his moves on tariff war. But again, I believe market unnecessarily feared it too much, I believe, because India trade surplus with the US is around $40 billion, which is nowhere comparable to $361 billion of trade surplus China generated in 2024 calendar year. US can, affect India because this doesn't include this IT exports. I am talking about the goods exports. If US makes any adverse move, then yes, we will have problem. But then there is theoretically or logically, there is no fear on that because the tariffs are more or less similar. You take a GST or you take income tax in both countries in treating IT services. So therefore, I believe market is slowly getting some confidence on that. That is a third. Fourth, as I've been discussing with you repeatedly, despite such a crash, the investor inflow is continuing. Even last week, over 5.5 lakh new investors have entered. So 5 to 8 lakh new investors are still coming into the market. Prior to that, 2 weeks prior to that, it was even 8 lakh per week, 7 to 8 lakh. So obviously, when new investors come, they would come with fresh resources to invest. The fifth reason, as of day for yesterday closing, we lost about 102 lakh crore of market cap. From 484 lakh crore peak level in September 2024, the equity wealth evaporated to the extent of 102 lakh crore, which was more than the entire market cap in 2014 May. That time the entire market cap was 84 lakh crore only. Now, such a huge fall, which was almost 31% of India's nominal GDP for FY25. So very rare. But of course, just because it has fallen, that doesn't become an argument for buying a stock. But then what happened? On the one hand, when, perception-driven stock, which do not have a justification for valuation comfort, and they fell very badly, the quality stocks also fallen very badly. Post to this, 31% of GDP level in the market getting wiped out, made many smaller pockets of small and mid cap segment very, very attractive. I could see the pulse of investors in my limited circle. So they all got attracted. So these are the, 4-5 reasons for market recovery. And also, as you go close to March, a lot of people have a tendency to book losses and reduce, overall tax liability at the second of the year, particularly when the first half was too good and second half was too bad. That also should taper off because now we are already into advanced tax payments. So therefore, I believe day for yesterday, probably the market has bottomed out. Yes, there can be volatility. 1 or 2 days we may fall, but I think the underlying trend has bottomed out and it is for a recovery. I'm not saying it is set for a massive rally, but definitely looks like we are set for a sustained recovery from the middle of this month onwards.
So, which means you're saying that foreign portfolio investor selling also should slow down or is slowing down already? Because that is what is triggering most of it, isn't it?
That we cannot derive automatically. That is a relative call. And they may wait for April 1st week for Mr. Trump to, clearly state what he intends to do in terms of tax policies towards India. But, the small and mid cap stocks are the main domain of the retail investors. That is where still a lot of growth opportunities, value unlocking opportunities are available. But to be fair, in the Nifty Sensex, majority of the sector, what I call as a single-digit growth syndrome, still exists. Unfortunately, even Q4, you may not see strong double-digit growth in sectors like cement, automobile, FMCG volume, IT service exports in dollar term. So there are so many sectors where you may have a single-digit growth syndrome. So it is too early to expect the FIs to turn buyer. It might take a month or it might take even a quarter. That is why I believe small and mid-cap segment should outperform the large caps in the very near term.
If I can ask you an interest rate question. So the CRISIL Ratings has just put out an outlook saying that they're expecting 50 to 75 basis point reduction in 25-26. The European Central Bank has on Thursday cut rates by another quarter percentage point. So it's now, rates are down further in the Eurozone. Now, all of this could, if there is a clear now move towards lower interest rates, do you feel that transmitting to better corporate performance, better balance sheets, and so on in this round?
Yes, definitely yes. As we discussed about oil price, that plays a crucial role in bringing down the interest rate also. Mr. Trump would contribute to worldwide interest rate cut because he would cause little global pain and that would translate into further crash in the oil price. Today, few days back, there was a report that small businesses in the US, which account for half of employments, they are feeling the pain of the trade war. They say that their margins have come down and profitability is hit. And today, there is a news that the employment job cuts to be a record level since 2020 COVID time in the US. That would mean deflationary conditions spreading, first forming in a significant way in US and then spreading across Europe as well. And therefore, the oil price should fall further down. Last week, Saudi Arabia and Russia announced a further increase in the oil output. And then Mr. Trump also for increasing the or maximizing the oil output in the US. All this would mean further significant fall in the oil prices. And secondly, the monsoon forecast, the South Korean agency says there could be normal monsoon for India. So if IMD also forecast, and with the record level of crop output expected in the current crop year, I think CRISIL statement could be understatement. I would say that confidently, if monsoon doesn't fail in a big way, I think the rate cut would be beyond the 50 basis point. And that would lift the market once again significantly.
Chokka, thank you so much for joining me.